Consider a trade. A stock has been moving inside a tight band for 6 weeks. Maybe $280 on the low end, $310 on the high end, so about a $30 range. Every time price reaches the top, sellers step in. Every time it reaches the bottom, buyers step in. Now the setup is so reliable that a careful trader can fade the top, buy the bottom, and collect on nearly every full swing. And say there's 3 of these such trades, and every single time 3 winners. So the trader's on this momentum high, if you will. And on an otherwise, now let's call it Tuesday, if you will, a single piece of news hits the market before the actual market opens, so in pre-market. Now with that, the stock gaps up from, let's say, 310 to $348. And the same trade that paid for 6 weeks is now a position that's going against you, and it's not going against you the same amount of dollars that you were when you were winning, maybe say $20, $30. Instead, it's now bleeding against you hundreds of dollars, and it feels like it's doing that every hour. Now, nothing about the trader has fundamentally changed. Nothing about the stock's fundamentals have changed overnight, assuming the news is about the market. But what did change is the market itself crossed a threshold. It moved from one phase to another phase. And on the other side of that threshold, the rules are different. You're now in a different market phase, a different market regime, and you need to adapt to that. That's what we're going to talk about in this video. Welcome back to the Physics of Trading. This is the final episode of a 5-part course on the physics of how markets actually move. Episode 1 was about motion. Episode 2, we talked about energy. Episode 3, we discussed oscillation. And in the previous episode, episode 4, we talked about temperature, tying it into black shoals. In today's episode, episode 5, we're going to bring everything together with phase transitions, the piece of physics that's going to help us explain why markets don't move through a single continuous state, but rather cycle through 4 very discrete stages, and each one has its own logic where, if you know what the logic is, you can be rewarded by paying attention and deploying the right trading strategies. Now, a quick recap. So far, we've talked about how a trend is a body in motion. A range stores energy, and an oscillation swings around a center. Volatility is the temperature of this entire system, and with those 4 lenses, you can essentially describe what's happening on any chart at any given moment. Now, what they do not describe is the larger context. They tell you what the market is doing right now, but they do not tell you which act of the play you're currently in. That's the gap that we're aiming to close with today's video. Now, if you begin with physics, in thermodynamics, a phase is a state of matter with stable, repeatable properties. Water at room temperature is liquid. Lower the temperature past 0 degrees and the same H2O molecules start to organize into ice. If you raise it past 100, you get steam. So 3 different sets of behavior from the same exact substance. Now, what's interesting is not really that these phases exist, but it's the transition between them is not gradual. Heat ice slowly and it warms in a straight line until it reaches 0 degrees. Then that warming stops. Energy continues to enter the system, but the temperature sits flat while the crystal lattice breaks apart molecule by molecule. Now, only after that last bit of ice is converted into water does the temperature begin to rise again. That flat region on the curve, if you imagine this as a curve, is the phase transition, a threshold. Once you cross it, the system starts to behave differently on the other side. Now, if you tie this back to markets, markets behave nearly exactly the same way as this property. They sit in stable phases for extended periods of times. Then you have the transitions, and the transitions are usually sharp, not gradual. And on either side of a transition, the same strategy will produce very different outcomes. Now, there's 4 different stages that a market can cycle through. The names come from technical analysis going all the way back to the Wyckoff period in the 1920s. This is Richard Wyckoff. But the structure is universal. The first stage is accumulation. This is the quiet phase which follows usually a long decline. price starts to stop falling. It feels less like catching a falling knife, and you'll see that it begins to move a little bit more sideways. And oftentimes, this period can be weeks, if not months. Volatility in this starts to compress, volume will often thin out, and nothing about this chart usually at this point feels promising, which is exactly the point of this market phase. The institutions that drive the next leg up are quietly building their positions, while you'll see in this accumulation phase, public interest is usually lower. It's accumulation from the institution side. The second stage is acceleration. Sometimes you'll also hear the stage described as markup. Here, price clears the accumulation stage with conviction. Volume starts to expand, and the trend takes a hold of the chart and enters the sustained uptrend. In this phase, you'll find that long positions work very well. Pullbacks get bought right away. You have the first pullback, the second pullback. Momentum strategies, which look broken in the first stage during accumulation, suddenly are working very well in the second stage of acceleration with very clear buyers defined. Then we go to the third stage, which is distribution. In distribution, the trend slows near the highs. Price still makes new peaks, but each one is shallower than the last. You'll see volatility starting to rise while progress in terms of price action starts to stall. This is really a mirror image of accumulation. It's the flip side. Smart money is starting to sell into strength that retail keeps buying. It's the end of a trend, if you will. Finally, you have the fourth stage, which is deceleration, sometimes also called markdown. Price breaks below the distribution range, the trend reverses, and this time bounces get sold and short positions work. The cycle stays in this range until the selling itself exhausts, and then one more time you get pushed into the accumulation range. So four very distinct stages, and they describe one overall cycle. Every liquid market repeats this structure on nearly every time frame, and you can take advantage of it very simply with something like our Market Pulse tool. Now let's look at two different examples to bring this together, and they're going to be in popular names, NVIDIA and Tesla. For NVIDIA, I'm going to rewind a little bit all the way back to 2021. In late 2021, NVIDIA, the stock had reached a peak of nearly $34. And then you'll see it rolled into this period of distribution. Now, throughout 2022, it entered a textbook deceleration phase. And how would you know this? Well, very clearly, you can see the market pulse being red. NVIDIA grinded down all the way for 12 straight months to a low of about $10.81 in October. Now, by late 2022, the chart you'll see had begun to flatten. From October 2022 through nearly 2023, it traded a very quiet base in the $14 range. Then in mid 2023, the catalyst that everyone now remembers, the broad arrival of AI, it hit the market, and you'll see the stock started to hit acceleration. It ran from $20 to nearly $50 inside of a period of 6 months. And again, very easy to see with the market pulse turning green. Now that's one full cycle, if you know. We went from deceleration to distribution to accumulation to now acceleration. 4 stages, and this time in the reverse order, we went from bearish to bullish, and you'll see just how that happened in a period of about 2 years. Now what's striking is that the cycle didn't really end there. From the 2024 lows, NVIDIA repeated this entire structure, but this time at a much larger scale. It ran from 100 to 150, then it distributed through the second half of 2024. It decelerated into the spring of 2025, bottoming near $95 in April, accumulated, and then it accelerated once more to over $200. The same 4 stages, again, just larger numbers now that NVIDIA is a little bit bigger. Now let's look at Tesla. Tesla through 2024 and 2025 tells a similar story. A pronounced period of acceleration in December 2024, again, very easy to see with the green on the market pulse line, with the stock reaching $490. Then we had this period of deceleration through the first quarter of 2025, which took Tesla all the way down to about the 220 levels. A quiet period of accumulation then through May, and then you started to see where the stock traded in a band, May, June, July. It's traded between 320, 340, Then you had another acceleration leg lifting price back to a new high near 498 by the end of 2025. Here's where I think most traders go wrong. They identify a strategy that works for a particular market stage, and then they keep applying it even after the market has moved into a stage where that previous strategy no longer fits. For example, a mean reversion strategy would work quite well during the periods in which oscillation strategies are meant to work. However, if you continue to keep fading the trend into a period of strong acceleration, that's a very easy way to watch your account get completely vaporized. On the flip side, if you're, say, a momentum trader and you keep buying breakouts while we're in this oscillation phase, say maybe in distribution, every time you think it's going to translate into this breakout into acceleration, you're going to get chopped to pieces, mostly because you're trading an oscillation period as a momentum trader instead of as a range bound trader. The dip buyer, for example, if you're a buy the dip trader conditioned by years of acceleration, if you keep buying the dip in trends, even the third, fourth, fifth dip, even after the trend has changed, well, now you're not paying attention to the new market stage where you might be buying dips in deceleration. So that's something you want to avoid. So in every case, the strategy is not broken. It's simply just more that the trader needs to recognize what market stage we're in and deploy the right strategies for that particular market stage. Now, this raises, I think, a question of how do you know what market stage you're in? For us, I use the market pulse line as I've called out. This is a very simple 10 period variable moving average. It's a free indicator. I'll leave a link in the description box below. You can see how it's built. You can see underneath the hood. You can understand every different piece that's going on. But ultimately, as a trader, the information that I get on a chart, in the top left, a label that tells me which one of the four market stages we're in. On the chart, a very simple line that tells me where I expect price to gravitate towards if we get a pullback. And that line is colored either green, gray, or red, depending on the market stage that we're in. It's a very simple way that I like to gauge the market stage and which phase we're at. And that's using the market pulse indicator. That completes the framework. 5 lenses for reading any chart. Motion tells you whether the body is going somewhere. Energy tells you whether the stored potential is about to release. Oscillation tells you whether the system is swinging around a center. Temperature tells you how violently the underlying participants are moving. And finally, in this video, we learned phase transitions tells you which one of the 4 stages the market is currently in and how close it might be to the next one. Most charts you'll look at for the rest of your career are some combination of these 5 ideas. A trend in acceleration would say rising temperature, or maybe an oscillation in a period of distribution where you're starting to see price compress. I hope through this entire series, you've understood now how to tie this back to real world concepts and use that to better understand the market through a lens that few can, and use that to become a better trader. Hope you found this series helpful. Take care, everyone. Good luck trading, and we'll see you in the next update.